Picture this. You just sold your property for $1.5 million. You did the math a dozen times. You walked away with what you thought was $300,000 in profit. You celebrated. You told your family. Maybe you already started looking at your next deal. And then, 6 months later, a letter arrives. It is not from your bank. It is not from your realtor. It is from the Canada Revenue Agency. And the number on that letter is $195,000. Not a penalty. Not a fine. A tax bill. On a house you already paid taxes on. On a property you lived in. On a renovation you did with your own savings. Your $300,000 profit is now gone, and you still owe them money on top of that. This is not a hypothetical. This is the reality that hundreds of Canadian property owners are walking into right now, completely blindsided, because nobody explained to them that in Canada, you can get hit with two completely different tax systems on the exact same property. Capital gains tax on one side, HST on the other. And if you trigger both at the same time, which is easier to do than you think, the financial damage is catastrophic. So today, on Canada Property Watch, we are going to break down exactly how this double tax works when it applies, how the CRA decides which category you fall into, and most critically, what the specific mistakes are that cause ordinary homeowners and investors to get crushed by a tax bill they never saw coming. Stay with me through this entire video because the strategy section at the end is what separates the people who keep their equity from the people who hand it over to the federal government without realizing it. Let us start with the fundamental difference between these two taxes, because most people, including many who have owned property for years, do not actually understand what each one is designed to capture. Capital gains tax is designed to tax your profit. It is the difference between what you paid for something and what you sold it for. In Canada, 50% of that gain is included in your taxable income. So if you bought a property for $800,000 and sold it for $1.1 million, your gain is $300,000. 50% of that, which is $150,000, gets added to your income for that year and taxed at your marginal rate. If you are in the highest bracket federally, you are looking at roughly 53% on that included amount. That is still painful, but it is a percentage of your profit. The starting point is always your gain. HST is a completely different animal. HST does not care about your profit. HST does not care what you paid for the property. HST is calculated on the full fair market value of the property at the time of the taxable event. In Ontario, the combined HST rate is 13%. On a $1.5 million property, 13% is $195,000. Full stop. Not on your profit, on the entire value of the home. Now here's where it gets dangerous. Most people walk into a real estate transaction assuming they are dealing with one or the other. Either I pay capital gains because I made a profit, or I pay HST because I built something new. What they do not understand is that the CRA has a framework that can reclassify your existing property, a house you already owned, into something that triggers HST as if it were a brand new build. And when that happens alongside a sale that also triggers capital gains, you are paying twice on the same house at the same time. Let me explain exactly how the CRA decides your home is now a new build, even if you never poured a single foundation. Under the Excise Tax Act, specifically the provisions that govern the HST Self-Supply rules under what is commonly referred to as the builder rules, the CRA has the authority to treat a substantially renovated property as equivalent to a newly constructed one. The word substantially is doing a lot of work in that sentence, and it is the word that most people skip right past. The CRA's own guidelines suggest that if the renovation removes and replaces 90% or more of the interior of the existing building, you have created a substantial renovation. But the threshold is not always about square footage. It is about the combination of scope, permits pulled, systems replaced, and crucially, what you do with the property immediately after. Here is the first trigger the CRA looks at. Renovation scope combined with resale timing. If you purchase a property, undertake a major renovation, and then sell it within a relatively short period, the CRA begins evaluating whether you are acting as a builder under the Excise Tax Act, not as a homeowner. The distinction matters enormously. A homeowner sells a personal residence. A builder sells a product. And when you sell a product, you charge HST, or more precisely, you are supposed to charge HST, and if you did not, the CRA will assess it against you directly. The second trigger is the self-supply rule itself. This one catches people who are not even trying to flip. Suppose you renovate your home to create a basement apartment. You complete the work, you add a kitchen, a bathroom, a separate entrance. The moment you rent that unit out for the first time, under Section 191 of the Excise Tax Act, a deemed self-supply occurs. The CRA treats that moment exactly as if you built a brand new rental property and then sold it to yourself at fair market value. You now owe HST on the fair market value of the renovated portion of the home. You never received $1 from a sale, but you owe HST as if you did. This is the trap that devastated the couple in British Columbia that many of our viewers have been asking about, who renovated their detached home to add a secondary suite and received an HST assessment of over $80,000 6 months after their first tenant moved in. The third trigger is the primary residence exemption misunderstanding. The principal residence exemption, or PRE, is one of the most powerful tax shelters available to Canadian homeowners. If a property is your principal residence for every year you owned it, you can eliminate your capital gains tax entirely, zero. But here's what almost nobody tells you. The principal residence exemption does not protect you from HST. These are two entirely separate federal frameworks. One lives inside the Income Tax Act. The other lives inside the Excise Tax Act. A property can be fully exempt from capital gains through the PRE and still be fully subject to HST under the self-supply rules if a substantial renovation occurred. They operate on completely different tracks, and the CRA collects on both tracks simultaneously. Now I want to walk you through a real numbers scenario so this stops being abstract and starts being viscerally clear, because I find that most people do not truly feel the weight of this until they see the math laid out in front of them. Let us say you bought a property in the Greater Toronto area for $950,000 4 years ago. You spent $120,000 gutting it, new kitchen, new bathrooms, opened up the floor plan, finished the basement with a separate entrance to add an income suite. Your total cost is now $1.07 million. You decide to sell. The market values the home at $1.5 million. Your gross profit before any tax is $430,000. Now the CRA steps in with two separate assessments. First, capital gains. Your gain is $550,000. You do not qualify for the full principal residence exemption because during the years you rented the basement suite, a portion of your home was used for income generating purposes. The CRA prorates your exemption. Let us say you lose 2 of your 4 years of exemption on the income generating portion of the property. Your taxable gain on that portion comes to roughly $80,000 in included income. At a 53% marginal rate, that is approximately $42,000 in capital gains tax on the income portion alone. Second, and this is the one that blindsides people, the HST Self-Supply assessment. Because you created a secondary suite, you triggered the deemed self-supply at the time the first tenant moved in. The CRA values the fair market value of the basement suite portion of the home. Let us say they attribute $300,000 of the property's value to that suite. 13% HST on $300,000 is $39,000. You never collected this from anyone, but you owe it. Your total unexpected tax hit is $81,000 on top of whatever income tax you already planned for. Your $430,000 gross profit has dropped to $349,000. And if you did not plan for this, if you already spent that money or reinvested it in another property, you now have a serious liquidity problem with a federal tax authority that has collection powers most people do not want to find out about firsthand. And here's the thing I want you to sit with for a moment before we get to the strategy. This is not the worst case scenario. This is the median scenario. The worst case involves properties with no principal residence exemption at all, full HST on the entire property value, and penalties for not registering as a builder. We have seen cases where the total tax obligation exceeded the original profit by a significant margin. People who thought they made money on real estate and ended up writing a check to the CRA, but there is one specific structural mistake that I see over and over again that makes all of this dramatically worse. And I want to explain it in detail because if you catch this mistake before you make it, it can save you an enormous amount of money. The mistake is this: selling immediately after completing a major renovation without a formal tax structure review. Not a general accountant, not the person who does your T4. A specialized real estate tax professional who understands the intersection of the Excise Tax Act and the Income Tax Act and can map your specific renovation scope against the CRA's definition of substantial renovation before you list the property. Here's why the timing matters so much. The CRA does not just look at what you did, they look at the pattern of what you did. If you bought, renovated heavily, and sold within 12 to 24 months, that pattern is consistent with what the CRA calls an adventure or concern in the nature of trade. That phrase is important. It means they believe your intention from the beginning was to profit from the property, not to live in it. And when they make that finding, the principal residence exemption becomes unavailable entirely. Your entire gain becomes taxable as business income, not capital gains. Business income is not subject to the 50% inclusion rate. 100% of your gain is included in your income and taxed at your full marginal rate. That changes your tax bill from a painful experience to a potentially devastating one. The document trail you leave during a renovation tells the story to the CRA without you saying a word. The building permits you pulled show the scope. The contractor invoices show the cost. The hydro records show when systems came online. The rental agreements show when tenants moved in. And the land transfer records show when you bought and when you sold. The algorithm connects all of these data points and produces a risk score. High scope renovation plus short hold period plus rental income plus immediate sale equals maximum audit risk. So what does a smart, legally sound strategy actually look like? Let us break down the 3 pillars that experienced real estate investors and their advisors use to navigate this landscape. The first pillar is intentional hold period management. Time is one of the most powerful variables in how the CRA interprets your activity. A longer hold period between the completion of a renovation and the sale of a property does 2 things. It weakens the argument that your intent was to flip, and it establishes more years of principal residence exemption eligibility if the property truly was your home. There is no magic number that the CRA has published, and every situation is fact-specific, which is why professional advice is essential. But the general principle is consistent. The longer your demonstrated occupation after a renovation, and the stronger your position as a homeowner rather than a builder. The second pillar is pre-renovation HST registration analysis. Before you start any major renovation, specifically one that will involve creating a new residential unit, or one that may meet the substantial renovation threshold, you need a formal determination of whether you should register for HST as a builder. This sounds counterintuitive. Why would you register for a tax you are trying to avoid? Because in many cases, registering gives you access to input tax credits that allow you to recover the HST you paid on all of your renovation materials and labor. For a $120,000 renovation, the HST on materials and services can be $15,000 or more. Recovering that through input tax credits while also properly managing your self-supply obligations can actually reduce your net tax exposure compared to not registering and getting assessed later with no ability to recover anything. This is a decision that a qualified tax professional needs to make on your specific facts, but understanding that this option exists is the first step. The third pillar is structuring the use of the property with the end in mind. This means making a deliberate decision before you renovate about what role this property will play in your financial life. If it is going to be your primary personal residence for an extended period, document that clearly. Keep records of your occupancy. Establish your utilities, your driver's license, your mail, your provincial health card, all tied to that address. The more contemporaneous evidence you have of genuine primary residence status, the more defensible your principal residence exemption claim becomes. If the property is going to generate rental income, make the decision to either structure it within an appropriate corporate or trust framework based on your specific situation and your advisor's guidance, or accept from the beginning that you are operating as a landlord and builder, and manage the HST obligations proactively rather than reactively. The investors who get crushed are not the ones who knowingly chose a high tax path. They are the ones who did not choose at all. They stumbled into one situation, assuming it was another, and by the time they found out, the assessment was already generated and the interest clock was running. Here is something I also want you to understand about how the HST self-supply trap has evolved over the last few years. The CRA has significantly increased its audit activity in this specific area, particularly in Ontario and British Columbia, because property values have risen to a point where the tax revenues from underreported builder activity have become substantial enough to justify dedicated audit resources. They are not stumbling across these cases randomly. They are cross-referencing building permit databases with land transfer records and rental listings. They are using this data proactively to identify properties that match the pattern. If your property matches the pattern, the letter is not a matter of if, it is a matter of when. When the investors who have been through a CRA audit of this nature and come out cleanly on the other side all have one thing in common. They did not wait for the letter. They had a tax professional review their transaction before it closed, or, in the case of the self-supply rule, before the first tenant moved in. That window between completion of renovation and first rental occupancy is the last opportunity to address the HST obligation on your terms rather than on the CRA's timeline. There is one more piece of this puzzle that I want to address before we wrap up because it comes up constantly in our comment section. The question of whether renovations done on a property you inherited change the tax picture. The short answer is yes, they can, and often in ways that make the situation more complicated rather than simpler. When you inherit a property, under Canadian tax law, you are deemed to have acquired it at its fair market value at the date of death. That becomes your adjusted cost base. If you then renovate the inherited property and sell it, your capital gains calculation starts from that inherited value. In many cases, because inherited properties are often passed down at a stepped-up value, the capital gains exposure is lower than it would be for a property you purchased years earlier at a much lower price. But the HST self-supply rules do not care about inheritance. If you substantially renovate an inherited property, the same builder analysis applies. The same substantial renovation threshold applies. The same self-supply trigger applies. Inheritance is not a shield from HST exposure on renovations, and many people incorrectly believe it is. So, let us pull all of this together into 3 actions you can take right now, regardless of whether you are planning a renovation, currently in the middle of one, or looking back at a completed transaction wondering if you are exposed. First, if you have completed a major renovation in the last 4 years, either on a property you sold or on a property you currently rent out, schedule a consultation with a tax professional who specializes in real estate and GST/HST matters. Not your general accountant, a specialist. Ask them specifically whether the scope of your renovation could meet the CRA's definition of substantial renovation and whether you have any unresolved HST self-supply obligations. The CRA has a 10-year collection window on HST assessments in cases of misrepresentation. Proactive disclosure is almost always a better outcome than a surprise audit. Second, if you are planning a renovation that will result in a new rental suite or a significant upgrade to a property you intend to sell, do not sign a single contractor invoice without first having a pre-renovation tax strategy session. The decisions you make before the first hammer swings determine the entire tax outcome. Decisions you try to reverse after the fact rarely work the way you hope. Third, get educated on the principal residence exemption designations and make sure you are actually filing them correctly. Many Canadians believe that if they lived in a home, the PRE is automatic. It is not. Since 2016, the CRA requires you to report the sale of your principal residence on your T1 return and designate it formally on Schedule 3. Missing this designation does not eliminate your exemption, but it can create complications and flags. Make sure your tax returns accurately reflect your property transactions every single year. The double tax scenario that we walked through today is not rare. It is not a technicality that only applies to professional developers. It is a set of rules that sits quietly in the background of Canadian real estate until the moment your transaction pattern matches the profile the CRA is looking for. And in today's market, with the renovation activity that happened across Canada during the last several years, the number of properties that match that profile is significant. Now, if you think the HST Self-Supply trap is dangerous on its own, I'll wait until you see how the CRA is using capital gains reassessments to claw back money from property owners who thought their transactions were closed years ago. The audit window is longer than most people realize, and the cases they are reopening right now involve numbers that will make today's scenario look manageable by comparison. That is what we are covering next on Canada Property Watch, and you do not want to be blindsided by it.